We're going to talk now about literally $1 trillion problem, that of non-performing loans in the banking system, or if you prefer, $1 trillion opportunity, depending on how optimistic you are. If you listen to the EBA numbers which came out before Christmas, they said that the total size of non-performing loans in Europe is about 900 billion euros, which, to put that in perspective, is about 6% of Euro GDP. And also, to put it in an even more scary perspective, is about 3 times the equivalent number in the US. There's been a lot of talk about ways to address this, a lot of support and a lot of coercion from the EBA and the ECB, which quite often founders on the rock of the Italian banking system and the inability of some Italian banks to realize losses on a rapid scale. But focusing in on the Central and Eastern European area, I think it's fair to say that the non-performing loan numbers are very mixed, although generally improving slowly. According to some figures that I read, there are 6 countries in the region where the extent of non-performing loans is more than 10% of GDP. Now, to help me discuss these topics, you have the panel in front of you, starting on my right, Noel Edison, who is in the financial institutions team of the EBRD, that team having, amongst other things, responsibility for the equity and debt funding of NPL services and investments in NPLs. Arturas Feferas, who's the Deputy CEO of Victoria Bank, which is, I believe, the 3rd largest bank in Moldova. And then on the left, Victor Levkanic, the Chief Investment Officer of APS Holdings. APS Holdings has focused on both asset management and servicing of distressed debt, and it's one of their key investment strategies. So thank you very much all for joining me today. I think, Noel, if I can start with you, the big picture of NPLs in the CEE region, which countries should we be most concerned about?
Right, thank you, Richard. I think first, it'd be useful to put things into perspective. If you look at the Italian banking system, for example, there are about 290 billion, or 16.4% of gross loans, which are NPLs, as at the first half of 2017. This compares to about 47 billion in Central Europe and Southeastern Europe, or about 6.2% of gross loans. Notwithstanding what we have in Greece, Cyprus, and Ukraine, at the end of 2016, about 122 billion of non-performing loans. It's quite a scale of difference there. Besides Greece, Cyprus, and the Ukraine, where the resolution of these NPLs is clearly the most pressing at the moment, as Richard mentioned, there are 6 countries within Central Europe and Southeastern Europe where the NPL ratios are above 10%, and those, in no particular order, Albania, Serbia, Croatia, Bulgaria, Bosnia, and Montenegro. 2 of those, Albania and Serbia, are greater than Italy's, and they're at 18%, and Serbia's at 17%. Now, even though the absolute amount of non-performing loans in those countries is relatively small, that's about 14.8 billion, what we find is that these NPLs represent a significant challenge within the local market. And I think from our perspective at the EBRD, what's worth noting is that there's actually a positive trend that we're now seeing. So that's quite good. And by way of background, the EBRD has been playing a pivotal role in the Vienna Initiative, which is a framework for safeguarding the financial stability of emerging Europe post the crisis. And its objective is to coordinate the deleveraging efforts of the European banks. And within this context, the EBRD leads the NPL initiative. Now, this is intended to build or bring greater transparency to the whole issue of NPLs, and with that in particular, greater accuracy in recognizing the value of those assets, and also recommending reforms in terms of legal and other reforms for restructuring those loans. We do this jointly with the IMF and the World Bank, and there are 5 countries right now that are partner countries as part of this initiative, and they are Albania, Croatia, Hungary, Montenegro, and Serbia. The framework so this initiative on the part of the EBRD is very important. Some of you may know, have a very active website that you can access, and will give you current information on what's happening across the board in our countries of operation, lists transactions that have taken place, and really is, I think, intended as a vehicle for trying to promote this transparency. The EBRD has just recently announced a framework that it's put in place, 300 million euros, and it's a resolution framework which is focused on distressed assets, where we will act as a co-purchaser of non-performing loans, and we will also act as an investor in servicing companies, and we'll touch on this a little bit later in the panel, where in some countries there's a great need to develop that industry because it's notably absent. Where we've seen actually the most activity taking place in terms of NPL sales has been in Romania, Croatia, and Hungary. And in particular in Romania, Romania has been particularly good at forcing a more accurate and transparent recognition of the price of those assets to the point where third parties have been asked to come in and provide opinions on the value of these assets. And importantly, what that does is close the pricing gap. And that's been one of the key factors that we've seen in why sales have not gone forward. And with that, I'll stop there.
Okay, thank you, Noel. Victor, where Noel sees problems, presumably as an investor, you see opportunities there. First of all, I think a two-part question, if I can. Given the list of countries that Noel mentioned there, in terms of having a problem and in terms of doing something about it, would you basically agree with that? And then second question, just to Noel's last point about the realistic levels, whether these assets are marked at a realistic level.
Well, I mean, I would look at it from the buy side perspective. So my view is a little bit skewed and sort of subjective. But indeed, it's basically the ability of the banks to offload or deleverage is a combination of country specifics, bank specifics, and the time. I mean, the whole NPL industry in Central Southeast Europe started before kick-started before the crisis, with actually first post-communist bad banks being created in Czech Republic and Slovakia. Two countries bailed out the banks and then sold mostly corporate loans in several transactions in sort of 2-3 years before the crisis. Then essentially the transactions again kicked in. Well, Poland followed a little bit by introducing different tax laws, incentivized the banks to sell in a larger scale in 2004 to 2007, I believe. This was a time when different tax schemes were basically still allowed. After the crisis, there was a sort of a time of just the gap being too big, banks restructuring the loans and basically somehow playing with the problem with essentially not addressing it. And then, as Noel pointed out, few of the countries came as a lead. Romania started with, again, country-specific national bank as a regulator, basically incentivized combination of measures the banks to essentially provision. Hence, the pricing gap was lowered. And then the bank-specific kicked in as primarily Austrian banks. Erste Bank basically started the market, was selling the most of their books, essentially across 3-4 years. We've been lucky enough to be the buyer of most of these deals jointly with our co-investors and managed funds. Then a couple of other countries followed, ex-Yugoslavian countries followed with the order of, say, Croatia, Slovenia, Serbia being the late. Again, those countries have been fueled by several banks basically taking a decision earlier than the others. Also, a interesting catalyst was essentially a bad bank of Hypo Alpe Adria, which executes its mandate very efficiently across the countries. So the combination of the country-specific with the regulators, local bad banks, as well as the bank-specific, that basically creates the transactions. There's still a nice pipeline ahead of us for next several years. Across the countries we mentioned, then obviously Greece, Cyprus will have to follow, but the pricing gap there is still very big. I guess we're going to tackle it later on.
Okay, I'll just kind of bring you in. So what are your views on, well, first of all, the level at which NPLs are marked, and I think specifically thinking about the forced accounting treatment under IFRS 9, which start to realize more realistically potential losses?
Yeah, actually, we've seen a lot of efforts by different regulators to enforce banks recognizing NPLs. It took quite a long time, and for several years we've seen that different countries were coping with NPLs. We still were increasing the number of NPLs because of late recognition. And this late recognition was basically due to several reasons. One of the reasons is local supervision, the way local supervisors were treating regulation, especially outside EU. Then legal system that was working in the country. It also, even if the banks wanted to dispose the NPLs to reduce the bad credits on the balance sheet, there was quite difficult to do it in local circumstances due to inability for courts to take timely decisions, inability to have expertise of specialized judges or specialized courts. That led to increased time for NPL recognition and also solving the problem. Actually, FRS 9, if we look to new regulation, which is from the beginning of the year, is applicable to many of the countries. We've seen that big banks, they're coping with the problem or with the new issue, hiring best consultants, trying to adjust the models that it has at low possible effect on capital. We've seen that, and there is a calculation that, according to estimate, it will be not very big impact on CET1 ratio. It's about 45 basis points. And on total capital ratio, it's 35 basis points, basically, which is not very significant and will not force the banks to some actions. At the other hand, everybody understands that NPL influence on profitability, on capital, because of the high risk of the capital. And at the end of the day, funding costs increasing for those banks who have high NPLs. FRS 9 and discussion how it will impact, probably the biggest effect will be when banks have to put loans from stage 1 to stage 2. And there are wide discussions how to define this increased risk for stage 2. Definitely, banks are now working out or worked out already on the local data and criteria how to treat this increase of the risk. But it does stimulate that more banks will have bigger impact by putting from stage 1 to stage 2, that will affect their profitability. And looking forward to FRS 9, I think for the moment it's still not clear impact, because banks are testing and running. The one issue which probably could makes bank worry how this new treatment will affect, and whether it's possible to somehow minimize this effect. Running parallelly, both FRS 39 and FRS 9 would help banks really to calibrate the system and see how it affects the NPL. Overall, I think despite the different accounting treatment, we've seen increase in NPL transactions, as it was mentioned already by our colleagues here in the panel. And I've just checked overall European transactions, and we have for 2017 about 140 billion of transactions for non-performing loans. Of course, leading countries like always South countries, Italy, Spain, Greece, those are taking a leading position. What concerns small countries outside EU, they are struggling, first of all, recognizing NPLs and then working out NPLs. And then lately it will come FRS 9 effect on those levels.
It's interesting there that if IFRS 9 is supposed to be a realistic marking to a level that potentially you could sell at, you mentioned, I think, 45 basis points as a Tier 1 ratio impact. When you contrast that with Italy, where it's all of your Tier 1, which is the problem in those Venetian banks and MPS, for example.
Yeah, actually, we have this gap between what banks expect to get and what they really can get in the market. And that is also one of the reasons why banks are holding up sales, because when they received, they are able to receive 10 cents per euro, it will hit and it will tear them down. So basically, this price gap holds up from certain transactions.
Mm-hmm. Let's turn to this EBA action a little bit, Noel, if I can. I guess there's a carrot and a stick with the EBA, as always. The stick being forced to write off on a very aggressive timescale, the carrot being, and here's some means to facilitate secondary loan sales. Have you looked at that?
Well,
I believe?
it's interesting because what the EBA is doing, we're hoping will carry over into accession countries and also other countries within Central Europe and Southeastern Europe. The EBA has proposed these new regulatory capital rules that, in effect, make NPLs more expensive for banks to hold. And in particular, what they are doing now is they're forcing banks to dispose of them by a certain deadline. What we're seeing at the moment is that the current proposals, the current prudential backstops for insufficient provisioning would require financial institutions to fully cover with their common equity Tier 1 capital their unsecured parts of all new NPLs after 2 years. So you have a unsecured NPL on your balance sheet. It's been there for 2 years. You have to provision 100% capital. So that becomes very quickly a very expensive asset to hold on to your books. And then accordingly, we'll encourage you to sell those assets. Unsecured consumer loans, for example, are quite common in terms of asset sales that we've seen in the NPL market. For secured assets, then they're looking at longer periods of time, but ultimately by year 10, and this is still being decided, there would be a full provision required for those assets. Now, this is to be regulation that's relevant for only new NPLs going forward, so it doesn't do anything in respect to the legacy NPLs that are sitting on the balance sheet. But I think it's a good start in terms of forcing banks to recognize what the true value of these assets are. You will have equally in that situation where you have an imbalance where you have one set of assets which are identical, but they're new and they're 2 years old, they're fully provisioned, and you have historical assets sitting on the balance sheet which are 5, 6, 7 years old and they're only 60% provisioned, then clearly there's going to be pressure from the regulator to have equal treatment of those assets. Now, this doesn't help directly resolve the issue of NPL stock. It does, however, give banks a very strong incentive. Now, one of the things that the EBA is coming forward with templates. And I think this is particularly helpful. There are 2 sets of templates that are going to be a way to commonly collate information and provide that to sellers as part of trying to facilitate a greater market flow in terms of NPLs. So it would intend to be widen the investor base. It would lower entry barriers for people coming in because they don't have to sort through it themselves. It's already put in a format which will be known. The data and the availability of that data will be improved significantly. That helps with price discovery, and then we would hope improves the number of transactions that you see going forward. Now, this is currently proposed for European Union countries. It's not contemplated for EU accession countries, though we have flagged it as something that we would like to see in time. There are 2 types of templates that are being considered. One is a portfolio template, and this is a sort of a broader macro picture in terms of the portfolios that are up for sale, all in standardized format. And then you have the transaction templates, which are much more granular, provide much greater detail in terms of the particular asset and collateral and maturity dates, performance on the loan so far. And one of the things that certainly is an issue within the European Union, and we will find it in other countries, is the issues related to data protection. So by way of example, in the UK, if you have a property and you put a postcode on it, you know who lives there. So you can't, that's just the way it works. In other countries, postcodes aren't used in quite the same way. So there is going to be some further refinement that takes place in terms of how that data is presented. And then with each type of asset, and there are different asset classes as we know, there'll be some further refinements in terms of how these templates are put together. But this is, I think, an extremely good thing. Our own personal experience, and we've been in these bidding situations, is that the way in which the data is presented, the quality of it, is such a wide range that it can be a disincentive because the amount of time and money that's spent trying to understand the assets, to value them. You have separately legal issues that come in that can be quite expensive. We sat through one bidding process where and it was unsuccessful, I should say, and the consortium spent $1.2 million in due diligence costs. So you can't do that quite a lot. So this, I think, is a very good thing in promoting what I describe broadly as liquidity in the market for NPLs.
I'd like to ask Victor your perspective from the buy side. Before I do, there are two very quick questions. So firstly, the templates aren't a regulatory requirement. It's completely voluntary.
That's right,
It's
yes,
a tool
yeah.
if you want to use it.
Yeah.
And secondly, why does it take a regulator to do this? Shouldn't that be an industry initiative? The securitization market did it, the covered bond market come up with their own industry-led initiatives, standardized data.
It's a very good question, but...
That means you haven't got an answer, right?
Well, what I would say, though, is it's not easy to do. So, one, you need to bring together a group of countries and regulators, respectively, to agree on a common format. Everyone has a different view on this. They will, in turn, be guided by the data that their own respective financial institutions have in country, and it may not be as good in some countries as others. So you end up with a dilutive effect in terms of what you're reporting.
Right.
And finally, it's a cost to the banks. They have to spend time and effort, and it will take several months to start collating all of this data. I think once, though, that becomes part of the way banks do business and collect data, then this will be a very good thing, and it certainly will come much easier.
Okay. Victor, from a buy side?
Well, I mean, the introduction of templates to collate data in a right quality, that this is the music to our ears. Obviously, we all are spending on a buy side, we all are spending quite hefty budgets on the due diligence. So just to reiterate, the quality of the data quality is a key, and the process. So basically, two things which are very important for a deal to happen: the process to be set properly with the committed seller, and within the frame of the process, which is mostly two-stage, I mean, standard two-stage process, the data being offered in a first stage, where the desktop pricing is being done. You know, the ability to indeed price the collaterals is the key. I mean, basically the hard value of the NPLs. I'm not talking about the unsecured NPLs, but I mean the hard value of what the major problem is are the secured NPLs, and the hard value of it is real estate. So unless we can price them correctly in a first stage, in a desktop stage, then the seller and its advisor cannot really create a real shortlist, cannot distinguish between the pricings. So there is a big trade-off between the transparency, I mean the disclosure, and the data protection. In case, you know, in some extreme cases, you know, you receive a data tape where it says collateral is in Croatia. Well, doesn't help.
Right.
Or we said what a northern, southern part of, sometimes it says the city, but it doesn't help either. So, you know, we have to get through the first round somehow, and then in the second round, a lot of time the seller basically has to do even so-called red data room and green data room, red data room being accessed only with the qualified advisors, and, you know, it just creates a lot of burdens and in the process. I mean, sometimes even the sell-side advisor need to sanitate the data which our advisor produces for us, which is ridiculous and crazy. And at the end of the day, it ends up with basically a lower number of bidders, good for us, bad for banks, and lower prices. Again, good for us, bad for banks, but doesn't help the industry to create volumes. So going back to what Noel was describing, coming out with the templates and having data presented in a way one can price them will be a tremendous help, obviously.
Arturo, so
From bankers' point of view, actually, regulators could force those templates, and that would be probably the most efficient way, because there will be always issues for costs of the bank. There will be issues about transparency, because banks do not want really to disclose what is the real situation with their portfolio. And another issue which probably is crucial there, about collateral valuation, because different countries actually now have different rules for collateral valuation. And looking to the portfolio, basically without more details, you cannot have your own opinion about what is really sold with this, let's say, NPL. So I'm for those templates, and also putting them to broader perspective, not just EU. Of course, it will come with subsidiary banks that European Union countries owned outside EU, but I believe that templates would improve the market transparency also outside EU if they are enforced.
and also presumably if you want to sell to an EU bank, they would expect this template to be the standard.
Yes, and it would reduce due diligence cost, because now what we've seen, small countries with the small loan portfolios, they do not afford this. You have to combine several countries, several banks, and that's crucial, that there is sort of one background for everybody to put all the things together in order to achieve some better results.
That leads on to a very general question that I wanted to ask everyone really about EU parent banks with subsidiaries outside the EU and the extent that the EBA's rules apply to them. Who has any thoughts on that?
Yeah, actually, me working in Moldova, I've seen how local regulators are basically addressing the same issues as they addressed in all around Europe. They're putting the same requirements, the same regulations. We have, let's say, as an example in Moldova, Basel III, FRS 9, all those European regulations that are common for EU countries. So I think this change in some countries are fast, in some countries still lagging behind. If we look, let's say, maybe towards east, they think that they have their own good risk classification, good provisioning system, and they basically do not need any EU guidance on that.
One topic I'd really like to get onto, Victor, you mentioned briefly the different models of bad bank across Europe. I know that the EBA chair is still talking about the possibility of an EU-wide bad bank. Do you think that's viable? Do you think that it's potentially conflicting with state aid rules? Is it a going concern?
Well, I mean, if we look to Ireland, probably would be a good example with the National Asset Management Agency, or NAMA as it's known. It was put in place in late 2009. It was primarily set up to acquire property development loans from Irish banks. The exchange was with government bonds. The haircut was 30%, largely believed to be inadequate, but that was the deal that was struck. And so effectively providing a subsidy to the banks. That did reduce NPLs for the Irish banks. It did at the same time create what would be the largest property developer in the world, which was NAMA for a period of time. NAMA did come under criticism in terms of management of some of these assets. There were issues about corruption, and so it's quite a large thing to take on in that situation. I think the current situation is very different now. Banks have capital, so it's not so much an issue of capital. It's actually getting the banks to remove the assets off the balance sheet and get it trimmed down to an appropriate level. I think the issue of state aid rules is valid. So we have seen, in the case of Slovenia, for example, the asset management company was set up, and the discount for the loans was relatively low. Certainly not what would be an appropriate level for private equity bidding for these types of assets.
Therefore, state aid.
So it could be seen as state aid. And it just creates a problem further on down the line in that you have an asset management company that's trying to sell assets which will be sold at a loss because in the first instance weren't acquired at the right price. So I think it's different now, and so I think it's less clear the role of a bad bank, certainly in Central Europe and Southeastern Europe at the moment, because they are relatively well capitalized. And just picking up on an earlier comment, the actual provisions that we see in a number of these countries is relatively good. You're looking at a coverage ratio of about 63% for the average, and then Croatia, Bosnia-Herzegovina, and Albania having a coverage ratio of about 70%. So I think there's a lot of work that's gone already on that. So it's not clear to me that they have as clear a role as they might have had at the start of the crisis.
Victor?
Well, from our end, as the bias perspective, basically the bad banks represent a different commitments to handle the NPLs. Most of the bad banks at the moment, either state-owned banks or essentially, well, state-owned but created for particular institutions, have basically a limited timeline to exist, and then they need to be dissolved, essentially by law, which is exactly a great news for the market because that creates a transaction certainty. Hence, my experience lately in last several years with bad banks is primarily positive. Again, as discussed before, some of them have a mandate to manage more actively and sell partially. Some of them, I mean, larger volume of them, have a mandate to sell as much as they can, transparently for the highest prices they can, and then being dissolved. This basically this opened up the market. It fueled the market in Croatia by, Heta as a bad bank after Hypo Alpe Adria. We had a chance to do a landmark transaction in Serbia late last year. There is a landmark transaction going on, hopefully successfully, in Bosnia Again, a first deal ever, committed seller, and other deals to continue. Same with distressed real estate / NPL sellers, such as Imigo and ex-Volksbank. All those entities which are with a clear mandate are creating a market, or helping to create a market. So from our end, we really welcome it. The processes are transparent. They always hire advisors, which is the best thing, and just to maneuver through the peculiarities, and they always sell once they start, unless some really major disruption happens, which no one can foresee.
Arturas, does that chime with your experience?
Yeah, actually, we've seen a lot of good and positive things with those asset management companies, especially with the banks that operate internationally, to create that company that really takes care of the bad business and allow to concentrate on the healthy part. And we have been looking to transactions where, let's say, bad banks of different subsidiaries in Baltic countries were grouped and sold out. So basically, that helps to solve the problem.
I'm very conscious that we're running out of time. It would be remiss, though, not to give you an opportunity to ask questions about anything we've touched on. In the front row, please. Who, wait for the microphone. And thank you.
Damian Damianos. I own a consumer lending company in Moldova, which has NPLs considerably lower than the average bank, be that as it may. The question to the panel, in particular to Mr. Edison, who oversees several banks in several countries, is the NPL, is it the ideal that the NPL should be zero, or is there an optimal level of NPL that should be tolerated in the interest of the economy? To put it in context, I overheard a conversation between two world-class economists, one of them a Nobel Prize winner. One said, I've never missed a flight. The other said, you waste too much time in airports. This obsession with minimal NPLs, and in particular what I think is an illusion that the longer the template, the lower the NPLs, ignores factors that are much more important. Growth in the economy helps reduce NPLs. Credit expansion helps reduce NPLs. General confidence in the business. So what would be the ideal tolerable target for NPLs? And would it be the same across countries, or would there be significant differences between, say, the UK and Moldova?
In answer to your question, I think there are two aspects to this. There is the level of NPLs on a balance sheet that would be expected in the ordinary course of business in an ordinarily healthy economy. And so if you take, so is there an exact number? No. And it will vary between countries. But if you're looking at, what's happened in, for example, Greece and Cyprus right now, where you're, 40, 50% NPLs, that's too high. Where you had Romania, it was at 23%, that's too high. But when you start looking at numbers below 10%, probably around the 5% mark, then I think things are getting back to normal. And this is my personal view. You can manage a situation with investors if you're looking to issue shares in the market or debt, where you have a plausible story. If you're under 10%, probably closer to 5%, maybe below that if you've got a strong economy. So that's one part of it. So what's that level and appropriate for the country? The second is actually, what do you do with them? So it's, are they provisioned and are they liquid? So can you actually sell them? Can you move them off your balance sheet? Can you, as a financial institution, focus on the business of lending rather than managing a portfolio of non-performing loans? So I think it's a no absolute answer, but
maybe From my end, again, it's a little bit subjective, but you know, we've been doing this for 15 years across the countries. So what we see is a practical end of deleveraging. If banks are selling mostly asset-backed, I mean real estate asset-backed loans, there's a major repricing of the real estate happening on the market naturally. No equity owner of the real estate, unless it's indebted, would declare its own property having a lower value. But once it comes on the market as a distressed property in a larger scale, there is a major repricing. New life comes into showrooms, into whatever, restaurants, abandoned industrial complexes. And this is happening. This is real in Romania. This is real in ex-Yugoslavia. I mean, sorry for using the name. This is real in Bulgaria, and it will become real in Greece and Cyprus. Just banks need to start offloading.
Okay. Thank you very much. It was an excellent question, but I am being told we really have to move on to the next panel. So please stay in your seats whilst the next panel comes to mic up and talk from an investor's perspective. And whilst they're doing that, please join me in thanking the panel.
Thank you.